a warm welcome to today's enlightening webinar, The Yin and Yang of Investing, Active and Passive Strategies in Symbiosis. I think we're really happy to have every one of you join today because we're going to be exploring this dance between the two important and most prominent investment approaches that has always been in debate, but let's see how they work out as a complementary tool. So in the realm of investing, the interplay between active and passive strategies is similar to the concept of yin and yang, which are seemingly two opposite forces, but when harmoniously balanced, give great results. So let's look at it how that works for in a portfolio. So our webinar is aimed at looking at what active and passive is, their characteristics, what is driving investor choices, and also the evolving landscape and how decisions are being made. We will try to understand how active investors today are looking at alpha and the passive investors' requirement for simplicity. So let's evaluate both these worlds. I have a panel of eminent experts who will share their insights and experiences today and give us strategies that can offer. Let's welcome Chintan Haria from ICICI Pru AMC. He's head of investment strategy, and there is a lot on that slide. So you can look at what the slide has to say. So I will not read all of it, all his achievements across. So please do read that. Next, we have Benedek Voros. We call him Ben. He's an ex-colleague of mine, so I know him very well. He's Director of Index Investment Strategy. Welcome, Ben. And welcome, Renu. Renu is a part of the ARIA group, and she's co-founder of Finscholarz and a wealth manager herself. And she advises a lot of clients to make effective portfolios. So without further ado, let's start this discussion, and I'm pretty excited to have it because it's always been an active and passive debate. But let's start with some basics. So Chintan, I'll give it a go starting with you. So can you help us understand just the basics, fundamentals? What is active, what is passive? Because we have a mix of audience here, some people who are from the investment world, some people who aren't, who are getting in, so they want to know what is active and passive, just the basics, and what's the complementary feature, and what is the whole debate all about?
Thanks, Gwen, and thanks to ETF Junction for allowing us to talk on this webinar. If we look at India in the context of the financial landscape, we have made rapid strides. Earlier, probably we had to explain to investors why equity is important in their asset class, as an asset class in their portfolio. But today, luckily, with more than 8 crore Indians having demat accounts and a large part of Indians having mutual funds, I think 4 crore Indians having mutual funds, at least the knowledge of equities as an asset class is stronger. Now we moved on to the debate of having within equity mutual funds or within mutual funds, you have active and passive, and that's your question. How do we define active? How do we define passive? It's pretty simple that active fund management, which has been in vogue for the last 25 years in India, has been pretty dominant even today in terms of the AUM. Active is dominant. It's essentially a fund or the group of funds which is managed by fund managers based on the specific scheme objectives. So let's say a large cap fund, the fund manager would buy what is called large caps by picking and choosing the stocks within large cap, by diversifying the sectors which the fund manager likes. So there is a fund manager's active involvement in managing the fund. So the money which an investor puts in an active fund is actively managed by the fund manager by picking and choosing the right sector, right stocks in the right weights. On the other hand, the passive funds, or what is called the ETFs and index funds, which is together called passive funds, are something which are basically funds which endeavor to basically follow a benchmark or have weights, stocks, sectors based on a particular benchmark. So let's say there is a large cap benchmark, let's say Nifty 50 or Sensex 30, that in the weights of the Nifty 50 or Sensex 30, all the stocks which are there with the specific weights, the fund will have to basically replicate that. And there is no fund manager's choice or active fund management involved there. I cannot remove any stock. I cannot change the weightages. And that's called passive investing. So active investing is where an active fund manager is making the choice of the stock or the sector and the weightages. And passive investing is essentially index funds and ETFs, which are following a particular benchmark index, which is predefined. And in that benchmark index, all the stocks in the same proportion, in the same weight, are basically followed in the index fund or ETF. So it's a very simple concept where in active funds, there is active involvement of fund managers in choosing and stocks and sectors and weights. While in passive funds, there is no active involvement of an active fund manager. It is decided by the index provider and the methodology is already predefined. And the fund management team has to basically have the portfolio in the same weights as the index. Those are the two which are there in terms of active and passive. Thank you.
Thanks, Chintan. That was a simplistic overview of both the strategies. So going over to you, Ben. Let's dig a little at your global experience and understand how has the active and passive debate been playing out. What is the kind of global trends that you have seen, and how do you see the debate today progressing over the years?
Yeah, thanks, and it's a pleasure to be here for me as well. So if we will track back first for the history of the active and passive fund management industry, active fund management really started in the 19th century in the UK, where the first trust funds, diversified funds, got going, and up to the early 1970s, so almost for 100 years, there was only active fund management industry and individuals who have been trading the markets. They participated in trading activity. And in the 1970s, academic evidence started to accumulate that a large percentage of active managers are actually not able to beat their benchmarks. Like the earliest such study that we could find on the desk originates actually from the early 1930s, when a researcher called Alfred Kohls scrutinized the track record of the active managers at that time and concluded that the majority of active managers were not able to beat a relevant benchmark. As a consequence, the first index funds in the US started in the 1970s, which is now Vanguard Group. And obviously, it was a slow process at first for investors, for active investors, to come to terms with the fact that actually the vast majority of them were not able to outperform a passive alternative. So it's really from the 1990s where the asset growth of passive indices really started to catch on, and the first version of passive funds were typically representative of a very broad market. So in the case of the US, it was the S&P 500, and later on, as the passive market became more sophisticated, dedicated passive strategies, including small caps, mid caps, growth style, value style passive funds have become available and gained prominence in the investor community. Where things stand right now is that a trend that originally started in the US has spread globally. So what we witnessed around the world, in Europe, in Latin America, and of course in the Indian market as well, is that in recent years the growth of passive have far outpaced that of active, and in fact there have been a strong gain in market share for passive strategies and passive investment vehicles versus or vis-a-vis actively managed funds in pretty much all the categories that we track globally.
Yeah, Ben, I completely agree with you. I think the global trend is something that we also share. Definitely in India as well today, it's almost 17% of the total industry AUM that's in passive. And that's been leaping and growing in terms of product ideas, in terms of number of investors, the kind of assets that are coming in. So coming to you, Renu, we are seeing that growth in the passive space. But keeping in mind and looking at you where you are engaging with so many investors, right? Are you seeing that bias between active and passive? Do you see a growth in passive? And is there a tilt still towards the active? How are preferences changing?
See, unfortunately, first of all, thank you very much for having me here. And it's a pleasure, always a pleasure talking to you, Koyal. So let me come back to what investors are thinking as per your question. Unfortunately, in India, our financial literacy is still at a very low level. So a common investor is not able to differentiate between an active and a passive strategy. It boils down to the advisor to be able to guide them through it. As a matter of fact, a lot of times people don't even understand that SIP is not a product. Right. I mean, I'm sorry to say, but that's the kind of illiteracy we have in our society right now when it comes to personal finance. So the investor is rarely coming to us looking for a passive strategy or active strategy or something like that. And then it falls in our list of duties to figure out what is going to work well for them. We have a very low level of awareness. So I think ETF Pathshaala kind of things will really increase that awareness of utility of the passive way of managing funds.
Yeah, thanks. And Renu, I absolutely agree on the financial awareness and the need for it to grow. I think that's the reason we have ETF Pathshaala. We do agree it's in its nascent stage, and today it's more of a push towards getting people to equip themselves and create that education and awareness. But I'm sure that we will reach our goals because we have industry experts who are coming and consistently pounding this message across. And for those who are interested, they will get this message. So we will move over to Ben. And Ben, this is one of the unique things about our region is that while passives are growing at a very, very fast rate, we can actually grow faster if people do understand the value that passives bring in. But you have been penning down the SPIVA report for a very long time for this region, and recently the recent report is also out. So given in context of the recent reports and a look back at what the India trends have been, what is your take on the region and how SPIVA spells out the statistics for passive?
Yeah, absolutely. We have been publishing the SPIVA India scorecards for 10 years. The first report that came out was over 20 years ago for the US, but we gradually expanded around the world. So the India SPIVA scorecard in particular has been publishing since 2014. And the trends, by and large, in the Indian market tend to be fairly similar to what we see around the world, in that in most categories, most of the time, the majority of active managers tend to underperform the passive benchmarks, especially if you look at a longer time horizon. And of course, on the short run, over 6 months, over 1 year, there is considerable variation around the mean for underperformance rates. So, for example, in the first half of this year, we saw a much higher than usual underperformance rates for Indian composite bond funds, where 95% of them underperform relevant benchmark, while the ELSS fund category actually had a very low underperformance rate of around 18%. So around not 3/4, but 4/5 of managers managed to outperform. But these short-term drivers tend to mean revert and dissipate over longer horizons. So what we see if we observe and examine a 10-year track record for most active managers is that the majority of active managers tend to underperform a relevant benchmark.
Yeah, that's a fact, Ben, and I I think I agree with you. Renu, SPIVA is a report that we've been publishing. The markets have been, writing about it. And, you did mention about, investor awareness not being as equipped on it. But does a report like SPIVA and a lot of other conversations in the market help you take those help you make those dialogues rather to your investors, so that at least you can create a somewhat symbiotic relationship where you can add more passives as well into the strategy? Because we've been talking, I know I've been talking in the market about core and satellite. So if there is a bias towards active, you can always keep your active as your core and keep your passive as satellite, because I know how the importance in a financial advising is that you have to create a balanced portfolio. So how has that been working out for you?
Yeah. So first of all, coming to SPIVA, undoubtedly these kind of reports and regular updates help us a lot. So my clients may not be aware of what's available in the market, but we need to keep ourselves abreast of things that are happening in the market and what's the best possible solution for clients. Now I'm a SEBI registered investment advisor. I work only on fee basis. That makes us 100% fiduciary. So the first prime duty of a fiduciary is to be able to work in the client's interest. And then it doesn't matter whether it's coming from an active strategy, passive strategy, or some other kind of a financial product or a strategy or different kinds of products, so to say. So what we do is, yes, SPIVA helps us a lot. Our internal researchers also add to the knowledge or the awareness that we have. So I'll come to your core and satellite portfolio and the portfolio construction element that we bring into our practice. So what we look at is three factors rather: risk, return, and then cost of investment. As long as we balance the three things, it's going to be working. It will be, the result will always be in favor of the client. We look at the risk element, first of all. So whether it's active or passive, both of them are kind of at a similar level, depending on the kind of portfolio we are looking at. The returns are the second aspect which we look at. Now, in our experience, what we saw is that when it's a secular bull run, very few or sometimes none of the active managers are able to beat the index. Even in small cap and mid cap, I have seen that at occasions that when the bull run is secular, that means everything is going up, it's very difficult to beat the index. But at the same time, when there are segments growing, obviously there are opportunities to pick up different stocks and beyond the index, and active are able to perform much better than passive. So how do we put it down in our portfolios on a practical level? Then we look at the third aspect of cost and do that cost benefit analysis. So when it comes to large cap, we have seen with the help of passive strategy, we are able to bring down the cost of investment by almost 1.5% per annum for a client. Because instead of taking a large cap fund, if I go for index, I'm bringing down the cost of fund management, and at the same time, I'm also able to get the benefit which would be there for the by holding that particular basket of stocks. The one greater element of confidence, one more element that gives us more confidence in that kind of a strategy is that now the portfolio is very transparent to us. So it's not even that 80% is in large cap, 20% in mid cap or small cap. So the risk element is very, very much in our know. We know what's happening to the client, what can happen to the client's portfolio. So that is where we look at our practice level. I would like to say we have core portfolio is passive and satellite is active. That means large cap in our particular practice, we have large cap is almost 95%, not 95, 90% in passive. Mid cap and small cap is something where we take tactical calls depending upon the market conditions. So I hope you got your answer, Koil, and if you need more clarification, do let.
Yeah. Thanks, Renu. I think that clarifies a lot and gives a little bit of a guidance in terms of how one sees tactical allocations. And then talking about allocation and management, Chintan, coming to you because you've been seeing investor trends. You have seen the SPIVA report, being coming up with repeated trends in terms of active unable to outperform the benchmark in certain categories. Now over a period of time, it has been a trend that we've been seeing. Now if that has been thing, what do you think is the hurdle that is not propelling passives even further? Because it's very simple, right? Why should I not get into the top 50 or top 30 stocks rather than evaluate through a lot of active funds, etc., where I don't know the fund manager, I don't know the fund manager skills, etc. So how do you think that today investors are viewing the active and passive space, and why isn't passive growing out even more than what it currently is?
So I think when we are talking of active and passive, and I'm using the words very carefully, active and passive, because I do believe that there is space for both. It is not a diplomatic answer, but why do I say a space for both is because the third option which investors have, and today a lot of investors are exercising that, is essentially investing in the markets directly by picking up stocks, right? So on one end, in India, out of the 800 lakh crores or $10 trillion of savings that we have, only about 5% to 6% is in equity. So the first step is to get investors into equity. Then within that equity, and I think advisors like Renu are doing a fantastic job of at least getting investors to allocate something to equity. Now, when something is coming to equity, where does it come? Whether it comes into direct equity or into active funds or into passive funds, that's the debate or discussion that it has. If it goes into direct equity, do the investors have the necessary skill set to actually invest directly? They may feel in bull markets that they have. So when we look at the SPIVA report, it is comparing active and passive, true. But if you look at this, it is not possible to compare every investor with active and passive. But if you did compare, very few would be able to beat the fund manager. So here the choice is you invest directly, or you have active, or you have passive. I feel that there will be times where active will do well. In a country like India, there will be times where passive will do well. In a secular bull market, as you were explaining, there is a very high chance that index funds end up doing well because everything is moving. Even the scripts which probably do not deserve the kind of valuations, they are moving because liquidity is driving that. And it's only when a full cycle gets completed, let's say in 1999, 2000, we had the technology cycle. 2008, we had the real estate cycle. In 2018, we had the mid-cap, small-cap cycle. When that cycle completes is when the active fund manager's skill set will come out in terms of their ability to outperform. I do understand that in the long run, we've seen times there when the average active fund manager has not been able to beat the benchmark. But it is still better return than probably what the investor would have got had the investor not been in equities at all. So the question here is, be in equities, whether it is active, whether it is passive, that's fine. But be in equities, and within active and passive, none of us can know which one will perform where. So probably have a 75% allocation to active, 25% to passive. If you have the ability to pick up passives on your own without having probably advisors advising you, fine, you can go and additional. But there is space for both. For example, in passives, there is no option to invest in asset allocation product, right? At a time where debt markets or debt investments in India, be it of all kinds, right? From bank to mutual funds to insurance, everything, if you look at it from a debt taxation perspective, is now taxed at the marginal rate generally. And so if you have a product which essentially allows you to have equity and debt and a combination of both with the dynamic allocation of equity based on the market valuations, why not have that as your portfolio? So that comes only in active in India. Right now in India, there are no passively managed dynamic asset allocation products the balance advantage fund category. So you need that in the active space. You will need certain themes which may not be available in the passive space. So horses for courses, different points of time, and that's where advisors like Renu ma'am are extremely important for all listeners. So one advice to all the listeners, have an advisor in place, because you will not be able to know what are the moving parts that can impact your portfolio. And more often than not, the investors make the mistakes of being very low in equity at a time where they should be high, and vice versa. And that is where the advisor will probably control your emotions and greed and have the right allocation to equity and other asset classes, and you will not miss out on the equity allocation. So whether it's active, passive, that's probably less relevant, but being in equities is more relevant. If I have to give a very non-diplomatic answer, there will be times where certain active funds will do well, certain passive funds will do well. I, with my 18 years of experience, also haven't always been able to say, yeah, value will do well, we know, but when will value start doing well? Growth will do well, but when will growth start doing well? So I think having a balanced portfolio of about 6 to 7 funds, having all the strategies in a particular weightage, and that's where the advisor will come in handy, will be a better suited for the investor, rather than bothering too much about whether active fund managers are able to do their job or not. They're doing a good job in terms of allowing you to participate in equities in a sensible manner and making money out of equities. Whether they're beating benchmark at all points of time or not, they're still making you probably more money and allowing you growth. And of course, if you have passive funds also in your portfolio, so have both is what I would probably strongly suggest, rather than focusing too much about active and passive. Have equity in your portfolio. Thank you.
Thanks, Chintan. I think I've been also a strong propagator of that. It's not active or passive; it's both active and passive. And I think, Renu, that's something that you would be also probably integrating when you are advising investors. And how do you? I think we had a discussion earlier where I think investors are very challenging when it comes to returns. Like you're saying, an overall portfolio return, they will always be comparing one against another. So it must be a big challenge for financial advisors today to also tone down expectations, right? Everybody wants 100 to become a 400, but they will not look at what the risk elements of that is and whether the portfolio balancing is right. So how challenging is to date for you to be able to advise your clients to create a balanced portfolio using that appropriate mix and meeting those expectations that they have on a holistic portfolio goal?
See, creating a portfolio is easy. Convincing the client is the most difficult part. And making sure that they hold on to that kind of an allocation and go through that life cycle sometimes gets very hard. And I'm coming out right now because I'm struggling with a client who has been with me for 9 years. Right now, currently in last 1 week, I've been struggling with her. She has been with me for last 9 years, has gone through all the ups and downs of the market, made decent money. Right now, her balanced portfolio has an XIRR of about 14%, 13.8%. Gone through COVID, 2016, all the cycles for that matter. She has also been our advertiser for that matter. She went out, gave interviews to people that, okay, they're doing a great job for me. And being a single woman, her life changed because of the way we had put the plans and made her financially independent and everything. And in spite of all that, now suddenly some friend who is investing in direct equity, like Chintan said, she has made 25% last year. My portfolio is only at 13.8%. So it is quite a challenging thing. And I'm traveling right now. So I told her, I'm going to come and meet with you in person and explain to you why is what and why have we done this? Why have you kept my money in debt, which is giving me only, 6% or 5% and 8% and all that. So it is very challenging. But what helps is 2-3 things. First of all, I think being fiduciary helps a lot, because they'll realize that we are actually not aligned to any other interest. We are aligned only to their interest. That's one major thing, how we are able to convince them. Second is, once a client has been there with you for a while, all the downturns of the markets are protected for them with a balanced or a structured portfolio for them, or what I would say a customized portfolio. That adds a lot of emotional value to their life, and that helps them stick on to that. Third is, whenever they need the money and it's available to them because the portfolio is constructed in that manner, that helps convince them. Initially, it is our communication with them, our capability to be able to show some sort of numbers, some past data, some past market performances, which helps us, I would say, which helps us help them manage their portfolios better. Otherwise, it definitely becomes challenge. A lot of times it becomes challenge, and I would be biased right now because I'm dealing with this client of mine. But out of 123 families that we are managing, this is one person. So it's like, at any point in time, there is 2 or 3% of clients who will still have, with whom we'll still have difficulty managing their behavior. So I would like to add one more thing to this, managing in terms of managing the behavior. We do something called money behavioral analysis for our clients. And that is something which helps a lot in managing their expectation, because we somehow get an idea of how they're thinking. And when we also know their family background, because we're doing everything for them, we know their background, we are able to figure out a little bit somewhere that where is this thought process coming from. For example, this 25%, I know where is it coming from, and it makes it easier for me to deal with it.
Yeah, I know. I guess it must be quite a challenging thing, but I do agree with Chintan as well, that I believe that financial planning and planners today are very, very important, and there are a lot of people who have not yet utilized that form of kind of advice. And I would also definitely talk to, I would honestly tell all the audience here as well that financial planning is very, very critical. Also, to all the audience who's here and attendees who are here, please feel free to add questions on the chat box, because I am going to wrap up in a bit. But we're looking forward to more participation. I have a lot of questions. I can go on for the next hour, but I'm happy to take on questions from the attendees as well. But I'll move over to you, Ben. We spoke a lot about the Indian markets, etc. But because you have a bird's eye view on the global markets, just wanted to understand how are you seeing trends in the passive and the active space play out? What are the new trends that are coming in the respective areas, and how is the uptake for it, both from a manufacturing perspective and both from also from an investor requirement and drive perspective?
Yeah, absolutely. So what we started seeing globally is that in market niches which were for a long time continued to be the reserve of active managers, passive strategies were being developed, and products were being launched which offer the passive solution for specific investment strategies. And to be a bit more concrete, there have historically been active managers which specialized in certain styles of investing, including investing in value stocks, which are trading at a lower price multiples, price to book, price to earnings than the overall market, or investing in growth companies which are growing their earnings and their revenues at a faster rate than the rest of the market. Or for that matter, there were managers which historically focused on conservative stocks which had a beta of less than 1 to the market, which really means that such stocks move around less than the overall market over a certain period. So these are specific investment strategies which were, the way we like to call it in our team, were indicized. So there have been a generation of new indices called factor indices, which are designed to mimic the performance of these particular investment strategies that select value stocks, growth stocks, low volatility stocks, and I can mention a dozen further categories that have been traditionally been a reserve of active managers, but in more recent times there have been more and more products that were launched based on passive indices, factor indices that basically invest in a group of or a basket of stocks with these particular characteristics that gives rise to a very distinct pattern of returns over a full cycle. So that's been a very prominent trend. And another one, if I can mention another one, is has been the rise of ESG investing around the world. So that has been most pronounced probably in Europe. That's where regulation and investor appetite has been growing at the fastest rate. But also elsewhere in the world, there is a growing interest in investing in indices that include firms that are complying with a high standard of environmental, social, and governance standards. Yeah, so I think I would highlight these two.
Okay. Yeah, no, and talking about factors, Chintan, I think one of the aspects, you being a part of a manufacturer, you have both active and passive strategies, right? So, when it comes to investments, balancing in terms of active and passive, I think in a part of our discussion, we also discussed how there could be strategies in active that are not there in passive and similar. I think one of the things in the factor space, which has been of late gaining a lot of, for us, a lot of pace, and I can say momentum, is momentum and low volatility. These are two surprisingly defensive plus cyclical kind of opposites that are attracting a lot of investors. So if there are these aspects of differences and gaps, as manufacturers, how can you push both these to get enough traction so that you can also offer that balanced strategy and provide the yin yang strategy for your investors?
So, as Ben was also mentioning, that the trend of factor-based investing and specific factor-based passive funds coming in, I think India also caught that trend, I think 5 to 6 years back, and we at ICICI probably today have about 5, if not 6 factor-based funds. To answer your question in terms of complementing, there will be times where you have standard products in active and passive both. And the way we see it as manufacturers, India has potentially 10 to 15 crore investors, which will be there in the next 10 years. Different age group, different styles, different levels of understanding of markets, different advisors, right? There could be distributors, there could be advisors, different modes through which they would invest. So all of them will need all kinds of products to basically fulfill their portfolio asset allocation requirements. And so as a manufacturer, we basically have the belief that we should have everything, both in active and in passive. And I'd stretch that to alternates also. So be it active funds and mutual fund side, passive funds and mutual fund side, alternates. We should have all the options which an investor wants to fulfill their asset allocation requirements, or an advisor wants to fulfill their asset allocation requirements on the behalf of their clients. And in that aspect, you mentioned about 2 factors, which is low vol and momentum. The fact that investors' learning curve can lead to any particular factor doing exceedingly well in terms of garnering of AUM and then eventually the investor experience. So if you look at low vol, I think in India, it was launched somewhere around 2016, 2017. For almost 4 years, it did not have much understanding, or people were not looking at passives. And within passives, what is factor-based investing? Just for the benefit of the audience, factor-based passive investing, much like what Ben was mentioning, is nothing but creation of an index on the basis of selection and weighting of a particular set of stocks, which are chosen on the basis of a particular factor or a set of factors. Effectively, if I want to create a portfolio of stocks, which basically in the past 6 months and 12 months have been the best performing, that's essentially me buying a set of stocks from a well-defined universe. So what Koel was mentioning, let's say the momentum 30, 200 index, which is there. So out of the top 200 names, which is there, 30 stocks are selected, which have been the best performer in the last 6 months and 12 months. And at every 6-month interval, probably the stocks are changed, or every 3-month interval, the stocks are changed. So effectively, you are getting the set of 30 stocks picked on the basis of a methodology that the last 6 months and 12 months, whatever has performed well. Now here, there is no filtering happening of what are the valuations. There's no filtering happening of which sector this particular stock is. The definition of the universe is top 200 names. Within 200 names, whichever is performing best in terms of price performance. So momentum is essentially one of the strategies which is gaining ground, because at all points of time, you are basically picking the winners of the past. Now, does this work at all points of time? Till the time the market is in bull market and the momentum as a strategy is working, it will work. When the bull market changes, I'll give an example of what's happened in the last 4 years or 5 years. There was a time where high quality stocks, which were expensive, was doing well till 2021. And they were probably part of the momentum basket in terms of performance and returns. Then after COVID struck and the market shifted from growth to value, there was a period where momentum underperformed because there was a shift happening from growth to value. When that shift happened from growth to value and in the 6-monthly rebalance, the stock selection changed from growth stocks to value stocks, and then momentum again started to capture the upside. So there may be times within the different market cycles that a particular sector or a theme like momentum may underperform, but eventually, as long as the momentum of particular theme or sector continues to grow strong, you participate in it. That's momentum. That's one style. You basically it's probably a high risk, high return strategy. At the same time, Goel spoke about low vol. What is low vol? You're picking up 30 stocks from the top 100 names, which have been the most stable, lowest volatile or low vol, but which essentially means most stable stocks. So across the last 1 year, the stocks which have seen least amount of volatility in their price performance is selected, and that is forming the 30 stock low vol portfolio. Now, those investors who really want a more stable set of stocks, which are, and by definition, stable stocks are something which do not move too much and do not create too much of headache when the markets fall. They are more stable. You want to create a portfolio of that. Again, that could be from different sectors, different times, different sectors are low volatile. You can have that set also. So low vol worked fantastically well in terms of performance between 2017 to 21. Last 2 years, it's essentially growth stocks, value stocks, which have done well, which have been more volatile, and hence low vol would have underperformed the value strategy. So at that point of time, value strategy does well. So it's essentially a combination of different strategies which can do well. But yes, momentum and low vol are, I would say, two ends, so to say, of the pyramid. Within that, then you'll have different factor funds which are there. But this is a space which is gaining ground. And as we see the advisory business grow and investors' understanding of passive factor-based investing improving, we will see these also grow. Because in an active fund, the fund manager, based on the intrinsic style of the fund manager, decides whether it's the value stocks that the fund manager chooses or there's a momentum element and filtering out some of the negatives. But in momentum and low vol or alpha strategies, you have a passive benchmark which is already predefined. So I think that growth will continue to happen as we see growth in India's equity basket. Today, let's remember that we have 8 or 9% of India's market cap owned by mutual funds in active plus passive put together. This number was less than 1% close to 15 years back. So foreigners are down from 22% to 17.5%. Indian investors are up from 1% to 9% in the mutual fund space itself. So that growth is naturally taking care of both active and passive. And with the Provident Fund investing in passive, the growth of passive funds is looking exponential because you have a very large pension fund of India investing in passive. So I think growth is there across the board in India in all financial assets. So I wouldn't worry too much about which sector or which place the growth comes in. But yes, investors have a lot of options, and that's a great thing from an investor perspective.
Yes, thanks, Chintan. That was a really, really nice explanation, because I think as people are wanting to get more than market return oriented in the passive space, they are looking at newer trends and options, and definitely factors are coming up as one of the more popular, options. But Renu, you spoke about, as some people not even understanding that SIP is not it's an aspect and kind of something. It's not a product. And with that context, forget that Chintan gave such a brilliant explanation of factors, but how do you see the adoption of such new innovative themes progressing, and how do you see that dialogue and this acceptance of new trends among investors who are still coming up the curve?
So there are 2-3 factors to this whole concept of how do we see the investors' interest building up. unfortunately, investors were more interested in crypto than equity just a few years back, and that's the sad part. So we are saying that the investor, a common investor, doesn't know one thing. Second, we are saying they're very conservative. They don't want to take risk. The equity market participation is low. But the moment some trend picks up and it gives returns and it comes in the market, becomes a headline news, everyone runs after it, and that is a sad part in financial markets. But that happens everywhere. How do we see these kind of a slightly more complicated concepts picking up? We see the route is through advisors, because they are the ones who are tuned in with the market place, that what new products and services are developing, and they're also in tune with what the common investor on the ground level needs, and they are a very good vehicle to be able to promote some new concept which will actually work for the investor, but at the same time not really, people really don't know much about it. And then there is this third segment of youngsters who jump onto every new word that they see. Uh, Usually that amount is small, but there's a huge number of them who immediately jump onto anything new that they see online. So online awareness campaigns and online discussions attracts this particular crowd who sees it all around on the social media and everywhere, tries to pick up the books and material and try to educate themselves and then get into it, to try just for the heck of trying to get into it. And then they have good experience, they will continue with it.
Yeah, and then there are the new Fin influencers who are freely giving advice. So,
so that's a different subject matter to be discussed
so
on a different forum.
Yeah, I guess. But Ben, coming to you, you've kind of heard. You've been in India now for a few days. You've been looking at the markets. How do you see and forecast the growth that you're seeing in other markets in comparison to India? And how do you see this from a futuristic point of view? What would just an overview or an idea of what the Indian markets will look like, from where you see it at this point of time? Just your take on that.
Yeah, so to answer that question, I would refer back to what Renu and Chintan mentioned previously, because both of them nailed down one very important factors each that are very important when we think about the long-term growth and long-term drivers of active versus passive in India. So Renu previously highlighted the importance of fees when assessing investment options, and I think one important driver in the market in India will be just the cost differential between actively managed funds and passive alternatives. As she mentioned, we did the research for figures in the US, and in the US there are roughly 0.65% difference per year between the cost of an active fund and a passive alternative. But as Renu highlighted, that the difference is even larger in India, which suggests that it's an even larger advantage on a relative basis in the Indian market towards passives versus an active alternative, because actually to kind of add value to that extent every single year after year, add 1% more gross of his value is increasingly getting challenging as time goes on. Another important factor that Chintan mentioned has been retail participation and the impact of retail investors on performance of active managers and the market as a whole. And Chintan very accurately pointed out that it is very unlikely for active private individuals punting on the market to outperform an active fund. And that is very true. And in fact, what we observed is that the very source of good performance for active managers is massive retail participation, because the more retail investors participate in the market, the easier it is usually for active managers to extract alpha from the market. So another important driver to watch out for is the professionalization of the industry in India, which happened in the past in the US, for example. So in the 60s, 70s, a big chunk, actually the majority of trading volumes were generated by individuals taking part in the market. But as professional fund managers took over and started to dominate the markets, the alpha that they were able to generate declined. Because if you think about it from the whole market's perspective, the totality of investors are the ones who own the market as a whole. So in order for active managers to outperform, they need to have less sophisticated players that underperform the market. And the one trend that we've seen in India as well, that the playing field has been more and more sophisticated. So CFA Institute is gaining membership. There are more and more very smart, very hardworking, very well qualified people and managers who participate in the market, and they have all real-time information at their fingertips. And as a result, they are competing and trying to extract alpha from players who are just as good, just as hardworking, just as well-trained as themselves. And that's again a factor which makes outperformance for active more and more challenging in India. And the third important factor, which is, again, we can observe if you look at the S&P BSE 100 or S&P BSE 200, or if you look at any Indian index of your choice, and you look at the distribution of individual constituents return over longer time horizons, let's say 10 years, 15 years, 20 years, what you tend to observe is that there's a small minority of stocks which really drive the return of the index itself. So in statistics, I have a master's degree in statistics, so the way we express that in technical terminology is that there is a very heavy right skew to the return distribution. And what that means is that it is getting increasingly difficult to identify those small handful of stocks if you are an active manager, or if you are picking stocks that really move the needle at the index level over the long run. So that's the third important headwind which makes active management challenging. So looking at or surveying all these three drivers, I think the trends are in place that have driven the rise of passive around the world. So just based on our experience in other markets, I would expect the trend to continue in terms of the migration of assets to passive solutions.
Yeah, thanks, Ben. I think that was quite a detailed and I think statistically driven kind of inference in terms of what would work and what doesn't. We just have enough time for another question, and I think I'll take it to Chintan in terms of, given where we stand in the markets, and you've seen the markets develop over the years, if we are always talking about the active and passive debate, if we are saying that passive isn't growing enough, I think there's enough active fund managers out there who still feel that even the active space has a lot of room to grow. So given that today global markets are at 10 trillion, we are at 90 billion, almost reaching a trillion, what will it probably take the passive to probably 10 trillion, if not 10 trillion, at least 5 trillion in the next how many years, and even for the active space to grow out, where I think from traditional bank deposits, etc., the transition starts moving into more investable or kind of vehicles, be it active or passive.
So I think from a numbers perspective, we are close to 1/4 in terms of mutual fund assets to banking assets, and within that, I think 50 to 55% is equities. The breakup, I think, is roughly about 27 lakh crores of total equity assets, out of which 5 lakh crore is passive equity and 20 to 23 lakh crore is active. What we must not forget is that in India, the alternate actively managed portfolio management services and AIF business, which is the PMS AIF business, is also close to 6-7 lakh crores roughly. I don't know the exact number, but roughly around that much. So the active part is growing. Mutual funds is part of it, but the PMS AIF businesses also, which are growing on the actively managed equity side, is also professionally managed funds on the active side. So if we add PMS AIF and mutual fund active equity, there is a very large portion still managed on the active side. As far as passive is concerned, the more we see investors understanding markets, the more we see advisors growing. India has a very low percentage of advisors today. As that advisory business grows, as family offices grow, their inclination towards passive funds and ETFs, because for investing in ETFs or index funds, you need to know the markets yourself, or you need to understand the products yourself, or you need to have an advisor, right? Because that's how it works. And as that grows, you will find even passives growing. I think in India, both active and passive will keep growing. There is no doubt in my mind that investors will save and they will have to invest in equities in some form or the other, whether it is active, passive, alternates, all three have space. And as long as investors make an informed choice of not probably getting sucked into euphoria. So, I mean, there was euphoria in a certain cryptocurrencies, etc., which were probably, we don't know the exact numbers, but the investors were getting there. Today, there is a euphoria on the SME side or the mid-cap, small-cap side, where investors, without having to do their due diligence, are just seeing the past return and investing. We saw them do that in Brazil. We saw them, in fact, Brazil funds attracted a lot of money in 2018. Internet funds, or so-called FANG stocks, attracted a lot of money in 2021. Now the mid and small cap, specifically the micro cap space and the SME space, is attracting a lot of money, which investors are investing directly. I think that's where we need to avoid those errors. And then whether you invest in active or passive, it will probably not make too much of a difference as long as you are picking the diversified side. And by definition, the regulator has put checks and balances in place that generally you will find enough diversification. Even in a sectoral fund, you'll have minimum 10 scripts, and you have stock caps and sector caps, which are rather stock caps and top 3 and individual stocks, which also reduces the risk of a client to a very large extent. And we as asset managers or as manufacturers also take a lot of, let's say, precautionary measures to ensure that the products which we have in place are reasonably well protected from any major unsystematic risk. If there is a systematic risk, in other words, if the market itself collapses, none of us can do much. But if there is an unsystematic risk, it should not harm the diversified investor. And that's what we try to do. Thank you. I think we've hit the clock at 6. Thank you so much.
Absolutely. Absolutely. Thank you so much. But before I go, I think there's one last question that's come up, and I'll take it up. And Renu, if you can quickly wrap it up. And it says that, could you provide some practical advice for an individual who's seeking to incorporate a blend of active and passive into the investment portfolio?
So I would assume that's a DIY investor. Go for passive, go for active in a very small proportion, because you can't go wrong in passive. You may not make that alpha, which everyone's talking about, but you will not get a hit either when things go south. So go for I would, if I were in your place, probably 90% passive, 10% active.
Yeah, and our question, thank you so much, Renu. And our questions have started coming in, but Ben, less than a minute, if you can answer what do you say are the advantages of using indices when it's in a diversified kind of a approach?
So the advantages of using indices are manifold. So over the longer term, their performance actually tends to beat that of active alternatives. And you also, another advantage, again, referring back to one of the things that Renu mentioned, is that you get exactly what it says on the tin. So she mentioned earlier that you don't have to worry about what's sitting in a fund. Like, it says large cap fund in the label, but it might have 20% small cap exposure, 80% large cap exposure. And that's exactly what one of the things that when we analyze the SPIVA reports and the numbers behind the report. That's one of the sectors that we have tended to find. And obviously, we didn't have time to dig deep into details of the various categories, but in the ELSS fund category, that's exactly what seems to be happening. That those managers tend to have like a small cap allocation, despite the fact that their benchmark is supposed to be larger firms. So that's definitely one advantage. And another advantage, which again, like we haven't spoken in detail about in the past, but actively managed funds often have higher frictional costs if an investor wants to adjust exposure for whatever reason. It can be that they need the money for personal reasons, for education of the kid, or just an emergency. There are sometimes redemption fees or bid-ask spread depending on the market that investors face. And the advantage of ETFs is that they tend to be not only the ongoing fees tend to be quite low, but the bid-offer spreads, so the costs of either buying or selling these shares tend to be much lower than for other alternatives.
Thanks, Ben. And that's exactly the amount of time we have. And that's a wrap from us. Thank you, everyone, for attending. Thank you, Chintan, Ben, and Renu for being a part of this education series. And I'm sure so many people benefited. I definitely did. Thank you for all for taking the time and coming on the ETF Junction Pathshaala. And we are very happy to have you. Thank you so much.
Thank you.
Very much. Thanks. It was a pleasure. Thank you very much, Ben.
Thank you.
Nice meeting you guys. Bye-bye.